Markets get defanged. And did anybody think that QE would never be a problem? What's up, everybody? Welcome aboard to Bubba's Bottom Line, and it's always great to be here with you and share some time and share my opinions. And of course, last week we had what we felt was going to be a huge news week and a week that would create either the big run up to the upside to make new highs or the opportunity to break the markets down. And we ended up with a little bit of both. It wasn't a great big explosion to the upside. As we look back at the three big things we were looking at last week were Facebook's earnings, Amazon earnings, well, actually four things. Facebook's earnings, Amazon earnings, the ECB, and the GDP number. So Facebook was the first to come out, and of course, Facebook got clobbered, losing the most market cap in one day of any stock in history. Now, again, I don't think that was totally unpredictable. Obviously, I never expected to see that big of a drop, but of course, the way that the stock had rallied up into the announcement, we assumed that there would be some selling pressure, no matter what the number was, and because the number was so dramatically worse than expected, the market sold off hard. If you remember the one thing always that's important is the human emotion that plays in here. So, excuse me, they were building up into this big excitement, expecting an explosion. And of course, they got an implosion instead, and Facebook got clobbered. But again, that's the human emotion part of the trade, right? They probably oversold it down a little bit too much, and of course, you've got all the pundits and experts making excuses and telling you either why it's going to zero or why it's going to $1 billion. This is one of the things that I always find interesting about the markets. But what wasn't surprising is the depth at which it sold off once it started to sell. You know, we saw the initial pop or the initial break off of the earnings number, and before you know it, if Facebook was churning around 195, 200, 195, 200, 201, 202, and then before you knew it, in about 20 minutes, it was down at 165. So again, not totally unexpected. Remember, if you remember the fact of emotion that'll drive these markets, you saw it. So then we had the ECB, which did nothing, which is no surprise. I mean, they're going to continue to stick by the motto, we'll do whatever it takes. But the euro currency was under a little bit of pressure. The dollar did try to rally. And of course, we can't quite get to that 95 in the dollar, but it hasn't been able to break out. Many of the experts were saying about what a key reversal the dollar received last week, which means that they think it's going much lower. And I will take the other side of that trade and say the dollar is going much higher, and that really it's just sitting in a consolidation pattern with nothing really to think about, and it continues to churn, and there's a big move coming, and I believe that big move is going to be up. We're looking for 97, and we're still calling for par or $1 by the end of the year, and then most likely higher than that. Again, I think that the euro currency itself is going to collapse, which would be very strong for the dollar as well. But then you had the Amazon earnings, which were good, and the stock popped a little bit, but it really gave back a lot of the action on Friday when it started to trade. But I think what you're seeing is some weakness here. You're seeing some issues within the NASDAQ. I mean, we targeted the NASDAQ at 8,000 as a high. We got very close. We're gonna say that the tops are in the NASDAQ for right now. Now, again, you have to remember that we say and we believe that the markets go up 8% year over year. Okay, so we're not saying that we're never going up again. I think at this point in time, you're probably looking at a 10 to 15 to 20% correction, maybe more. I expect to see action very similar to what we saw in January. Now, I'm not saying it's going to happen tomorrow. There are some other things I'd like to see happen, and we'd like to see this all peak at the same time, so we'll continue to watch that information. Now we had the GDP on Friday. Now, all week, everybody's pumping up. It's, I think the expectations were for 4.1% of GDP. There was some as low as 3.8, some as high as over 5%. But the number came out, and it came out as expected. Now, it didn't create major damage. What really happened was we saw some major divergences in the markets on Friday. What you really saw is you saw the Dow remaining the strongest of the indices, which at the end of the day is not the way that it should be. That's not a bullish market. If the Dow is the strongest, that is more of the defensive sectors. That is more things that you would look for, and that would be more of the safe haven type play. The Russell got clobbered on Friday. So again, the higher risk was getting clobbered. What we would call lower risk was rallying, and the Nasdaq was down, and it got really hammered late in the day once again. So there's a lot of signs of a lot of weakness here. Okay, there's a lot of things to think about within the market. Now again, we're not going to try to predict it. We are going to continue to stay on our trend and our track, which is we are observing, waiting for what we feel to be the best opportunity. Because if you look at the S&P, down a little bit for the week, not much, but still on the top side of a breakout. Okay, the Dow is still on the top side of a breakout. So again, there's no reason to jump in and say, this is it, we're going down, the markets are over. What we're saying here is that we want to observe, but we think that a top is more in place and we're more likely to see a bigger sell-off here. There are too many issues that are around this market right now that can create issues and create problems. Okay, one of them being the trade wars and the trade tariffs. And again, I have said from the beginning that I didn't think they were a problem. I think they're going to benefit us in the long run. And you had on Tuesday, or Wednesday, we had Trump. Wednesday it was Trump met with the EU. They made some progress. Okay, they made some deals. So what really happened here is, I think what you saw is that President Trump has kind of what we call backdoored the TPP, the Trans-Pacific Partnership. Now, again, he did not like the original deal. I didn't like it either. I think now what's happened is Mexico's going to come to the table. They've already made it pretty clear that they're looking to do something, and I think that their thing will be without quotas and without issue. You've got the EU now kind of on board. You're going to get Canada on board, which is going to kind of backdoor China and force them to come to the table. China does not hold any real trump cards over us, except for some of those their chemical stuff. But at the end of the day, okay, if they want to survive, they're going to have to do business with the United States. And I don't think that we're trying to not do business with them. What we're trying to see done is free and fair trade. And again, that goes into the entire market system. One thing that I've always wanted was free and fair trade. I do not want to have this manipulated market, which is part of, the markets have always been somewhat manipulated, but you had a chance for the free market to price the asset classes. Now you don't have that same opportunity. And now if we can get the governments out, okay, and get everything on a straight up, I've got this for sale, you want to buy it, here's the price. Oh, you don't want to pay that price? Well, let's make an offer, let's have a true price discovery model. That's what we have not really had over years. And we can talk about what has been the big highlight on all the TV stations. They want to talk about the farm products and the grains and how China's coming after Trump's base, which is the farmers. And yes, I understand that soybeans have gotten clobbered. But I'm going to say this, long before there was any worry of trade wars or tariffs, soybeans had problems, okay? People have been calling for $6 soybeans for years. So the fact that we had a sell-off and it was combined with the announcement of tariffs to me, is not a big deal. I don't think, if you look at the history of pricing over the last few years, you're going to see that we're not in that bad of a shape based on where we were, and that really has nothing to do with the trade wars. And this is what I think is the problem. We have the lobbyists and the politicians trying to make such a big deal out of it because they're trying to win votes. All right. And again, this is not about winning votes. This is about creating a free trade America, a free trade world where we actually can trade and buy and sell things at real prices without government quotas, without assistance, without everything else that goes along with it. And I think that is where the real problem goes in, because again, right now we've got quotas. Farm prices, ag prices are ridiculous prices. Okay, when you look at corn, even when it was at $4, it was ridiculous. Okay, Corn, wheat, soybeans, they're at historically low prices anyways based on what's going on. You go back and look in history, you'll see that they have not really moved to begin with, and that's a lot to do with a lot of the manipulation from the government anyways. Okay, so I think that is part of the problem, and it has nothing to do with the trade wars. I think if we settle and if we get everybody on board into a free market system, what that really does is it takes off the quotas from everywhere and it allows the free markets to trade, so people are going to go to where the price is the best. And as one runs out, you can see right now that you can bet that Argentina has raised their prices because a lot of the GDP number that we just saw was based on what you call front running. You know, everybody was buying before the news came out. Well, now all of a sudden that's what you have. So you have a lot of numbers that are still artificial. You have a lot of reasons to believe that we're going a lot higher. I personally believe that the grain markets are going to a lot higher from here. And I think that we're going to get those free markets. I think because what you do have right now in the White House is a free marketer, okay? My only complaint today of what President Trump is doing right now is the trying to talk to Chair Powell and tell him that he should not raise interest rates and tell him that he should keep the dollar weak. Again, I believe that you should let each asset class price itself, and then we wouldn't have these conversations. I think this is where you see it in the cryptocurrency world. I think this is why you're going to see the continued financial revolution that we're seeing with people moving into the cryptocurrency, because people don't want the government and the central banks to have control over their currencies. And we'll talk about that, guess where, in my commentary later. But we saw last week, durable goods missed badly. So you're starting to see a lot of things starting to sneak up that we're again, you can only run on debt so long. You cannot continue to run on debt. And I think that is one of the problems that you're going to start to see, we're going to start to experience here. This is an issue that everybody ignores. You know, it's amazing how the world believes that we can continue to try to borrow our way out of debt instead of having to settle that debt. And I think that's one of the big issues that we see. But when you look at things like durable goods, when you look at things like new purchases, you're seeing some dramatic weakness right here. In the meantime, we're going to step out here for a break. This is Bubba's Bottom Line, Todd Bubba Horowitz, and we're going to come back with more after the break. Our high school investing program, we are trying to really get this thing back on track, and I want to thank all of you who have helped with the donations to the program. We are into our 9th year, and this is going to be a key period. If we don't raise a little dough here, we're probably going to have to shut it down. In the meantime, if you'd like to help out, go to Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. And don't forget to catch the Bubba Show every day at 4 to 5 Eastern at libertytalk.fm. Now let's get back to Bubba's Bottom Line. Welcome back to Bubba's Bottom Line. Todd Bubba Horowitz with you. And of course, you know, you look at the markets around in general, and you look at the housing market. I think the housing market is in for a big, big beatdown. I think that once again, we have overdone the pricing on housing. I think we've seen far too much of the pumping up based on the cheap money, because the money is not going to remain so cheap. You are starting to see a lot of reasons to believe that debt is starting to rise, so which means that interest rates are going to start to rise, which means that actually affordable housing is going to start to disappear. But I think you've seen a lot of problems here in the housing markets. We continue to see worse and worse numbers, and I think we're looking for most likely a dramatic slowdown in the housing market. And again, I think this is again created by an artificial economy that you're starting to see. And I think one of the things that you should start to notice is the treasury bonds are being held at massively short positions right now. Okay, the notes and bonds are being sold short, which means that the people selling them are expecting much higher interest rates. If you watched last week, you saw the banks continue to rally. The banks are banking on having higher rates because that's where they make more money. If you understand how the bank works, they take the Fed fund rate and they add their basis onto it and the spread. Well, when rates are low, they can't get the spread wide enough. As rates go higher, the spread widens as well, so the amount of profit they make. And since they're already creating money out of thin air, okay, they're now creating more profit out of thin air, which is something that is a story for another day. But again, I will say, in my opinion, that there is not 1% of the banks have enough in reserve based on what they're supposed to have to what they're lending out on the street. Okay, this goes back in history as something, which is why you see these dramatic collapses when the money system dries out. And this is something that, again, they want to see higher rates. You're seeing a dramatic short interest grow in Treasury bonds. Now we've got the jobs number this Friday, which could create a big implosion here in rates. There's a lot of things going on right now. You know, if the numbers that we continue to see remain hot, that's going to force the hand of the Federal Reserve. That's going to force rates higher. Now, we already know that the markets themselves and the economy can handle higher rates because most people are getting their money either off their credit card or from these peer-to-peer lenders at much higher rates than they could borrow from the bank, if they could borrow from the bank, which is always a problem, okay? But I think, you know, we live under a lot of myths. And one of the things we live under is that the economy is in great shape. Well, it's only in great shape because we continue to build debt. It's not in great shape from a fundamental standpoint. It's in great shape because we can continue to see the debt bomb, the debt bubble continue to grow, okay? So that's an issue. We have got artificially strong markets because you have a lot of buybacks coming back. Now, if you remember that the stock market and the economy have nothing to do with each other, okay? They are not related. Yes, 90, I don't know if 90, whatever, a huge percentage of people have some interest in the stock market, okay? But either through work, their 401ks, their IRAs, whatever. But the overwhelming wealth does not come from the little guys that are in because of their jobs. It comes from the wealthy being able to churn out and continue to take advantage of every situation that comes into play. So that is an issue that we continue to watch and continue to look at. And I think these are the problems that are being created underneath the surface of the market. Again, you can go back to any major bubble in history, and they all end the same way. Do you actually believe that this time is going to be different in the way that it's going to end? I hope your answer is no, because it's never going to be different. You have the few fiddling around, making decisions over the markets that are not sustainable. So you talk about, you know, these great corporate buybacks. Everybody brags about how great those are. Do you know who's selling in those corporate buybacks? The insiders are doing all the selling. So basically, we're rotating from the insiders that owned the markets and their companies and their stocks. They're selling it, and who are they selling it to? Well, they're selling it to the retail investor. Typically, all markets will end when the retail investor is the big buyer at the end of the day. And that's something that you have constantly going on. And of course, we go from the trade wars to the currency wars. Now, again, I hate the fiat currency. I hate the currency war. I hate the ability that they all have to manipulate, which is, again, why you're seeing the growth in the cryptocurrency world, because the libertarians, starting with, and free market people understand that the cryptocurrency is most likely the new generation of money. All right? You know, many people are tired of the manipulation of the currency. And I think when you look around and you look at who's always fighting to keep the Fed running and to keep all these other things going, it's always somebody who is of extreme wealth, because they want to keep society depressed down based on how they can get their edge and how they can get their advantage. And I think this has not changed over years and years. Again, always go back to the movie, It's a Wonderful Life. Okay, Mr. Potter isn't selling, Mr. Potter is buying. Okay, and that's what we see here. We've come into a point where the very wealthy obviously run the country, and they want things to stay the status quo. And the status quo is not good for the masses, okay? It's only good for the little, and that's where I think you see much more of these problems. I mean, the volatility is going to come back into this market, okay? It may not be tomorrow, it may not be next week, it's gonna come back in. It's gonna create a lot of action, okay, which ties in what I talked about earlier, that the markets are actually looking for another 10 to 15 to 20 to 25% meltdown. I mean, I think, in my opinion, again, before this is all said and done, and I can't give you a time frame on it, because that would be me being an idiot trying to say when it's going to happen. But I believe that we're looking at most likely a 40 to 45% haircut in the actual markets when it does go. Now, again, it may not be for a year from now. I can't tell you when that's going to happen. But I tell you one thing, I see a lot of signs of things that are weak and things that are going to create some problems here. And that is something that we have to be concerned about. And again, you look at housing weakening, debt rising, no wage growth, okay? Insiders selling. So there's a lot of things that you're starting to notice. If you look at some of the individual things that are happening, and now you've got some experts are calling for, oil to go to 120. Really, morons? I'm not saying it can't get to 120, but maybe it'd be good if it could get over 75 first and then 80 before we start making, the reason those calls are made, just so you understand, those are direct shots at small-time investors that don't want to miss out on the ride. So you have some experts say, we're going to 120. Well, in the meantime, that expert is most likely selling, okay, every time you're buying, because they don't believe it's going to 120 either. Very, very tricky here. This is a very interesting time. These big calls are usually with greed in their heart and a reason for them to do something else. Be very careful. Now, I think one space to look at is the metals. Now, I do think gold is probably going down to 1180, but one sign to me says we're very close is the Vanguard fund they're throwing in the towel on their metals fund. So I think that, to me, is a sign that we're getting very close to a bottom. Remember, when people start to give up, okay, usually that's the time to start getting in. And when people are getting in, so at record rates, which they are now, margin debt is at record highs, the purchasing is at record highs, so everything is at records because we don't care about debt. So those are always signs that are clear, and they will play out clearly. Unfortunately, our economists, they don't see them until 10 years from now when it doesn't matter anymore. They won't be able to tell you that it was a recession until it was 10 years from now. In the meantime, the yield curve continues to flatten and is going to invert. You can bet on it. And that's going to create a recession. There's just so many things to look at. And that we didn't even talk about the defanging of what's going on. And have you been watching what's going on with Tesla lately? Have you been watching what's going on with some of the otve stocks? If you watch Netflix, all of a sudden it's suddenly fallen out of favor, down about 20%. Okay, have you watched, and again, you're starting to see a lot of warning signs. And it doesn't mean that you get out of the market. It doesn't mean that you shut it down. It means to be careful, to be cautious, and to be ready for what happens next. But if you're hedged, you never have to worry. And that's one of the things we always talk about here on Bubba's Bottom Line and on the Bubba Show and in general is make sure your portfolio is hedged. Then it doesn't matter and you actually make money. In fact, somebody sent me an email the other day that they were never so happy when a stock went down $40. A true story. Okay. In the meantime, we're going to step out here for a break. This is Bubba's Bottom Line, Todd Bubba Horwitz, and we'll be back with my commentary after the break. Bubba's Bottom Line, we'll be right back. Remember, everybody, high school investing, let's educate our youth so that I don't have to have these conversations. 10 years from now, I want to start educating people so they understand how the markets truly work. That's through my high school investing program. It's our 9th year, and I'm out of capital to continue to fund it. I have funded it myself. It's free for the schools. We've never taken a dime from anybody. Would love to have some sponsors that would help us fund this thing. But again, borrowing, we don't get that. And we're using Patreon, which is patreon.com/Bubba Trading. If you'd like to help us out. And thank you for those who've already done so. And don't forget to catch the Bubba Show every day from 4 to 5 Eastern at LibertyTalk.fm. Now let's get back to Bubba's Bottom Line and my commentary. Welcome back to Bubba's Bottom Line. And of course, it is my commentary. And every week I find something to bitch about. And, you know, of course, the easy target is always the Federal Reserve. And of course, this time is not different. They're still easy. You know, you've got a system that everybody thinks that this QE program we've done for 10 years is not going to create a mess. I believe that we're going to see one of the greatest crises of all time because of this ridiculous QE program. I think that the quantitative easing that has continued to go on is created probably the biggest debt bomb of all time. And when I talk about a debt bomb, you're looking at, when you look at the debt we had in 2008, okay, the housing crisis. The housing crisis, at least the banks owned real estate. They owned a hard asset that at least had some value. So even if they were overlending and overvaluing, they had a hard asset that wasn't going to dissipate to zero. Whereas today, okay, not only do we have the housing debt, which is ridiculous, and housing is dramatically slowing down, and of course we're having a lot of these no-doc loans and so on. You've got student loan debt, which is worth zero, okay, and you've got all these socialists trying to get, you know, no student debt and forgive it. Well, I want them to forgive mine. I'd like to get my $500,000 back from the student debt. And you've got auto loan debt, which is, again, a declining asset. So you've got the Fed that refuses to hike. You've got President Trump telling them that they shouldn't be hiking. Now, again, in reality, he should not have a say, and I don't think Chair Powell will succumb to the pressure, but the rates are going up too slow. So what's going to happen is we're going to have a jobs number on Friday, and if this jobs number is big, okay, which means unemployment falling, a lot of new jobs created, maybe wages growing, that's going to speed up the economy. And what's going to happen, as always happens, is the Fed is going to be behind the 8 ball and behind the curve, and they're going to be forced to raise too fast, which will create the next crash, okay? Because we continue to say that the debt bomb, the bomb is going to be 10-year notes over 3.5% and too strong of a dollar. But this is the blindness and the cluelessness of the Federal Reserve that refuses to understand how the true free markets work. So if you notice, the theme for a lot of today was the free market. And when you're having quantitative easing, you are taking away a free market. You are making the markets for only the extremely wealthy, which is what's helped create all these corporate buybacks, which has helped all these insiders sell their stock, which is on and on and on and on, which is, again, why you see other assets starting to bloom, for example, the cryptocurrency world. But this is where the Fed has to wake up, and either they're going to continue to destroy the economy, which if you read the book, The Creature from Jekyll Island, that is their goal anyways, or they're going to say, it's time, let's step forward. Yes, the market will take a hit, but at the end of the day, you've got too many people that are invested in the market. This market, the way that they're setting it up, with no other place to invest your money, will create the biggest tragedy in a long time, because we've got too many people that are retired, elderly, that are chasing the market because they can't get any yield on their money anywhere else, which is why higher interest rates are better. We need to see higher rates so that people who don't want to be in the equity market can actually put their money somewhere else in a safer asset class. But again, this is where the Fed will blow it. This is where we hear and we talk about auditing the Fed and getting rid of the Fed because they're far away from the job they were supposed to be doing. And they're creating, they are the massive bubble creators with no regard for anything else, because they won't know there's a problem until 10 years from now, when I can tell you right now, based on what I see and based on what I'm looking at, there's a problem today. And you continue to watch it, and you continue to send them limp behind, okay? The taper tantrums, all these things that they've done over the years, instead of raising rates, we'd be out of the mess already and in a true flowing economy versus the mess that's being created and the massive amount of debt. And until we take care of that debt problem, we're always sitting on a time bomb. This has been Bubba's Bottom Line. As always, I thank you for being here and thank you for being a part of the show. We'll be back on Monday with Bubba's Daily Update. Of course, we'll be back next week with Bubba's Bottom Line. Everybody have a great trading week. Remember, jobs on Friday. Could be a big number. Have a great day, everybody. Enjoy the rest of your weekend. As always, I thank you. Bubba's Bottom Line. Todd Bubba Horwitz.